Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is my co-host, Yahoo Finance senior reporter Brooke DiPalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be talking about how AI is moving from the building phase to generating real economic impact and how we can play that shift in the markets. Plus, we're going to throw in a little Fed and interest rate talk for good measure. Our phrase of the day is Amara's Law. We had to look it up, but it perfectly explains the hype and fear cycle in AI, what it's predicting for 2026 and beyond. And for today's market show and tell, we're going to break down relative strength, what it's telling us about the world's benchmark stock index, the S&P 500. Our concerns about concentration and narrow leadership, are they overblown? And this episode is brought to you by the number 4.95%. That's the cost of money for Uncle Sam's 30-year loans, and it's moving up fast along with mortgage rates. Why this is now a global phenomenon with Japan as ground zero. And today we are welcoming Scott Ladner, who is the Chief Investment Officer at Horizon. He's also on the board of the University of North Carolina Kenan-Flagler's Investment Management Center, bringing a derivatives, volatility, and macro lens to their investment decisions and risk outlook. He has decades of experience figuring out how to turn profits from some of the wonkier corners of the financial markets. So we are excited to see you here, Scott, to help us break everything down. Why don't you begin by just telling us how you're seeing the markets right now, where we are?
Yeah, well, thanks, Jared, for having me on, and nice to meet you guys, Brooke. So, look, right now we are pretty optimistic. Unfortunately, it's kind of a boring take right now because it feels like everybody is like a little bit optimistic right now.
About this market.
Like we all kind of know what the tailwinds are. You know, they're pretty strong tailwinds with respect to fiscal stimulus, both from the government side and the private side with capex buildouts. The Fed rate cuts are sort of in the market. You know, they were 12 to 18 months ago. Now they're actually making an impact on the economy. We know about all the some of the deregulation pushes and plans for that. The tailwinds are pretty well known. My issue is like, does everybody really have an understanding for like the sort of the weight of all of them simultaneously hitting to like all the same time together? Like that part, like I'm not sure that we've all kind of figured out exactly how it's going to end up functioning, because you could run this thing so hot that you reignite inflation or you get some other sort of issues. And look, Fed hikes are not on anybody's bingo card right now.
Perfect storm to the upside.
Exactly.
Anyway.
Well, let's get to our phrase of the day, and that is Amara's Law. It's named after Roy Amara, a technology futurist who studied how people consistently misread big innovations. Now, the idea is simple, and it's really important right now. We tend to overestimate what a new technology will do in the short term and underestimate how much it changes pretty much everything in the long term. And that's why AI feels so confusing right now. The hype and the fear show up first, but the real impact comes later as the technology quietly spreads through the economy, boosting productivity and margins. Now, Amara's Law helps explain why this moment can feel both disappointing and overwhelming all at the same time, and why the biggest effects are still ahead. Now, Scott, you introduced this term to us. What are your thoughts around Amara's Law right now?
I think, Brooke, you did an amazing job describing it. I mean, like, it is important and just confusing. And so, like, but understanding, like, hey, this is a phenomenon that happens. It's kind of like a behavioral science sort of idea, like a cognitive bias sort of idea. Like, listen, we know this is an important thing. We know AI is important.
Right.
How important? Incredibly important. What does that mean? Like how does that impact how I think about the world or anything else, or investing or anything? And the trouble is, we want to extrapolate things that like very short-term phenomenon extremely quickly, and that's kind of what the human psyche wants to do. And so, like, this is why we tend to like sort of overestimate how important AI is, maybe in the next 3 to 6 months. But it's really hard for us to grasp like how transformatively important something like a technology change can be. And so, like, we just can't even fathom like what the future holds. Like, what do we look like in 5 years from now with AI sort of infused throughout the entire economy? Like, I don't have the foggiest idea. I don't know what the jobs look like. I know they're going to be there. Like, that happens every single time. But I don't know really kind of functionally what this economy ends up looking like in 5 years. And so that's why we tend to underestimate sort of the future impact, because we can't really conceive of it. Our human brains can't conceive of like what this kind of transformative change might end up being. So it's a fascinating topic, though.
And we even heard from Jensen Huang, NVIDIA's CEO at the World Economic Forum in Davos, on Wednesday morning, essentially saying that this is going to create a ton of jobs, really even, blue collar type jobs. And that seems really important and could contribute back to the economy, even more so than we ever could have imagined.
Well, and think about sort of the population issue that we've got right now. I mean, China's facing this massive population issue. Like, the U.S., every developed country in the world is facing a working age population issue. Nobody's having enough babies. And if, the great salve for something like that is productivity enhancements. Well, how do you
Holy
get
grail of economists.
it is that thing, to push supply curve going right is like the thing that everybody tries to get. But the only thing that actually gets there is technology changes.
Let's bring this back to markets. So we have no idea. I don't think anybody has any idea what this is going to look like in 5 years. But how do you play the markets right now? So what are you thinking?
So in general, we're thinking we like U.S. equities most of all. We like emerging markets equities sort of second of all. We like bonds kind of least of all, like overall. But U.S. equities, broadly speaking, we like all the other stuff. So the only thing anybody's been talking about for the last couple of years has been the Mag 7, AI plays, NVIDIA.
So you like the 493?
Like the 493, yeah. And
which is the other 493 stocks in the S&P 500.
Thank you, Brooke.
and specifically within that 493, we like cyclical plays. So and cyclical plays or cyclical stocks or industries are those which are very sort of levered towards the the nominal GDP growth. So like when things are growing more quickly or inflecting higher in terms of like nominal GDP growth, the economy getting hotter faster, like those are the types of industries and stocks that we tend to like right now, because we do think we're going to get, at least for the first half of 2026, a really kind of run it hot type of scenario.
And even if we're off to this sort of weird start where we're seeing the Sell America trade, you're still a believer in this?
Well, yes, we are. And look, the Sell America trade is a possible fly in the ointment that we do have to sort of figure out. I mean, we obviously got news yesterday from one of these pension funds or one of the European folks saying they wish they're going to sell all of our U.S. Treasuries. They're sort of irrelevant, like they're tiny, so it doesn't really matter. But
more Japan, right?
And Japan, certainly, yes, absolutely, Jared.
We're going to get to that after the break. I want to kind of shift gears a little bit to today's market show and tell, and I'm glad you brought up the S&P 493. It directly relates. Today, we are breaking down relative strength. It's a way to compare performance between two markets or assets, and it shows which one is outperforming or gaining more than the other. And the two markets we're looking at are both based on the S&P 500 index. So first up, we have the market cap weighted index, which gives more influence to the biggest companies. It's one It includes NVIDIA, Apple at the top. All the mega caps have the most weight. And we're comparing that to the equal weighted version of the index, which gives every stock the same impact. Each stock gets one vote, no matter how big or small. So to find the relative strength and build a chart of it over time, we're taking the closing price of the S&P 500 market cap weighted index each day and dividing it by the closing price of the equal weighted version. And when the line is trending up over time, that means that the market cap weighted version is outperforming. And that's because it's being driven by a few very large stocks. Think concentration and narrow leadership. And when that line goes down, that means the equal weighted version is outperforming. The index, where every stock gets one vote, is doing better. So think broad participation. And if we plot this relative strength line all the way back to the 1990s, what stands out is that it's been trending up over the last 3 years since the beginning of this bull market. And that's not a surprise, because we keep hearing all the talk about gains being concentrated in the Mag 7 and a few other names. But what also jumps out is that the current level is much, much lower than the peak we saw during the dot-com boom at the beginning of the century. So, Scott, what are you making of this?
I think this is a great way to look at markets, Jared, and a great way to sort of think about this question. And what we think about broadly is, it makes sense for these other stocks to start doing pretty well. It also made a lot of sense for the last couple of 3 years, where the Mag 7 or the equal weight, the market cap weighted index was outperforming, because those were the most important drivers of economic growth. They were the most important drivers of the economy, and therefore in the market. And so, the history of this has actually made a lot of sense. Past couple of 3 years has been all about the building of AI capabilities. That's where the Mag 7 really matters. And so they've outperformed. But these next couple of years are going to be about diffusing AI throughout the entire economy. And so if that sort of diffusion process ends up happening, then the other 493, or the rest of the economy, the rest of the stocks, can start to participate, because they're going to start using this great tool for productivity enhancements and everything else.
So that line might go sideways, or it might actually go down?
We actually think it's going to go down.
Okay.
Yeah, we actually, look, we're not calling. I'm certainly not calling for NVIDIA or Mag 7 or any of these big mega cap names to go down. Like they don't have to go down for that line to go down. All they have to do is just sort of tread water, or the other ones outperform. And so we're actually thinking, we do think that the other ones are going to outperform. The 493 will outperform because of this faster economic growth and the broadening cycle of sort of AI adoption throughout the entire economy.
What are you telling your clients right now as they make their way into 2026, maybe a portfolio planning? It seems like the first half might outperform the second half, or how are you thinking about that?
You know, we actually we think we have a little bit better clarity as to the front half of the year, because we do think that the Trump administration wants to quote unquote run it hot. They want to run the economy hot, so they're going to do everything they can, stimulus wise and everything else wise, to get a really fast nominal GDP number. And stocks care about nominal GDP. And generally when people like us talk about GDP, we're talking about real GDP, which is this GDP,
After inflation.
After inflation. Stocks don't care about that. Earnings are nominal numbers. So, like, if we have an 8 or 9 or 10% nominal GDP growth sort of figure, which is kind of what we think we're going to get for the first half, that means that just sort of the average company, if they just sort of hang around and just do the general economic thing, is going to have earnings growth 8, 9, 10%. That's pretty darn good.
And in your notes, I remember you saying that's not an environment in which you have mass layoffs necessarily. So how do you think that translates into some of the weakness that we've seen in the labor market recently?
Well, I'm not sure as I characterize it quite as a weakness here. I mean, it's definitely stagnant.
Okay.
Right? I mean, so this is not a sort of a robust.
Like no high or low fire.
Yeah, and like everybody's been talking about this, and it's very true. I mean, we're in this weird environment where like companies are loath to fire anybody. They're also loath to hire anybody. So they want to, companies kind of want to figure out, what does AI mean for my labor force? And they don't really know yet. I mean, we heard it from some of the big banks, last week in terms of their earnings when they're talking about AI and using it in their workforces. They're talking about maybe like changing things on the margin, but no big sort of wide scale shifts because they don't quite know yet. So I think we're in this sort of like weird place where companies don't exactly know what to do. The economic environment, Jersey says, like, it's great. So you don't fire people when you're growing earnings 10% a year. That's just not an environment where you fire folks. So there's no reason to fire anybody. But if I don't really have a good firm grasp as to how I'm going to use AI in my business, I don't really want to hire a lot of folks either, because I don't want to end up firing them later on. So I think that's part of the reason why we're in this sort of stagnant place in the labor market. And so it's just it's a kind of a wait and see approach right now, I think.
Scott, we have so much more to get to, but we do have to take a quick short break. But coming up, we're talking about the higher cost of money for Uncle Sam and a runway showdown that takes a page from the world of college sports. Stay tuned. This episode is brought to you by the number 4.95%. That's how high the yield on the U.S. 30-year Treasury bond got on Monday, amid a big two-day surge. And it's the interest rate investors are demanding to lend money to Uncle Sam for 3 decades. Think of it as the price of money at the very long end of the U.S. yield curve. When that price goes up, everything from mortgages to corporate borrowing to stock valuations, they feel it. At these levels, we're getting closer to 18-year highs in long-term rates, and there's a pattern worth watching. Since 2023, when the 30-year yield has pushed towards or above 5%, stocks have tended to struggle short-term. It doesn't cause every sell-off, but it has been a pressure point for markets. So, Scott, what are the rising yield, long-term interest rates telling you right now?
I mean, they're telling us that people are a little bit concerned about some of this stuff, right? I mean, so you look, it depends on why do you get the rising rates? If you get rising long-term rates because people think that economic growth is going to be booming and everything's, like great and hunky-dory, that's kind of good rising rates. Like you can deal with that. The market can deal with that. On the other hand, if like 2022, if you get higher long-term rates because people are freaked out because they're seeing inflation and we don't know how high it's going to go, like that's the kind of high rates that cause the market a lot of turmoil, as we saw in 2022. This go around, it's got a little bit of both. So certainly everybody has. I mean, we talked a lot about some of the tailwinds of the economy this year, and we do think this is going to be a pretty strong economic growth year. So there is reason for longer term rates to be a little bit higher. But at the same time, we've got immigration pressures. We've got additional tariff uncertainty from the Trump administration, and we've got some weird sort of technical things going on in Japan that maybe we'll talk about in a few minutes that are kind of all of those things are applying upward pressure on long-term U.S. interest rates, and those are the wrong reasons why we have higher rates. So that's why the market's a little bit struggling right now.
I want to ask you about the Fed. I think most investors, as priced into the bond market, expect another interest rate cut, but we're pretty close to the end of the cycle. But I think the big question is what happens if longer-term rates at 30 or if it shoots up above 5%. And in the past, the Fed does have a toolbox to address this. Operation Twist, yield curve control. I'm wondering if you think, especially with the new composition of the Fed, we're going to get a new Fed chair in May, if any of that is a possibility.
I think, look, it's got to be somewhat in play. I don't think it's a very high chance, but I mean, Jared, as you said, like they have experience doing this. I mean, we know what works, and not only do you have tools at the Fed in order to manage some of these longer term rates, but if you remember, a year or two ago, everybody's watching the treasury auctions. Like, where's the treasury going to issue debt?
Mhm.
Like, what part of the curve are they going to issue? Like 3-month paper, or again 5-year paper, or 30-year paper? And there's a lot of angst about where are they going to actually issue debt? And the treasury came out and said, hey, listen, we're going to issue a lot of like short-term debt and not really issue a whole lot of long-term debt, and that had a massive impact on interest rates. So I think might be some combination of those tools in the toolkit, if longer-term rates do get too high for people's stomachs, that might come into play for this go around.
And just to take a step back for someone listening at home, maybe they, heard interest rates are going lower. Maybe they'll finally get into this housing market. Now they hear this and they're like, oh no, Treasury long-term rates are moving higher now. What would be your message to them?
Hang out. I mean, look, like interest rates are probably a little bit too high right now, at least in our view. The Fed is likely going to stop in the neighborhood of 3%. So if you think 3% is sort of like the stopping place for where federal funds, the Fed stops their interest rate cuts, it's probably the neighborhood of right. I mean, maybe it's a quarter point higher or lower, but it's the neighborhood of right. If you then apply kind of a typical spread to Fed funds in terms of to get to a 10-year rate with all the other sort of mitigating factors sort of ignored for right now, that'll get you a 10-year rate of 4.25. So and we're at 4.5 or so right now in 10 years. So rates aren't that far off of where they quote unquote should be. Now the challenge for mortgage rates, if we're talking about mortgage rates specifically, is that spread between mortgage rates and the 10-year. That's actually a little bit too wide right now. We're doing a lot of work actually at Horizon right now trying to figure out because there are reasons why that spread should be lower, especially with the interest rate volatility environment right now. But it is a little bit too high. And so there are some things actually in the toolkit to compress that spread between where mortgage rates are and where that 10-year rate is, and that we think some of those tools could be brought out in the next couple months as well.
Let's talk about Monday's price action, where we saw the Dow, S&P 500, NASDAQ had their worst day in about 2 or 3 months. Meanwhile, the bond market was where a lot of the action was too, and that's when we saw that 30-year hit 4.95%, our number sponsor here. And a lot of the headlines were attributing this to, as you said, this Danish fund dumping U.S. treasuries, but I think it was $100 million, very small amount when you consider this is a multi-trillion-dollar market. And what stood out to me, what was happening in Japan, and there the 30-year was up 26 basis points. That's 0.25% in one day, and that's a huge amount. That is a shock to the system. And just talk to us about the carry trade and how that might be affecting things, because it seems like global interest rates, at least on the long end, are very closely correlated, especially when we see big moves.
Yeah, they are. And then look, these can be very technical sorts of subjects, but at the end of the day, the thing that the audience probably needs to understand is one big market. So the market for government bonds.
I like that. It's simple.
It's there's a couple of natural buyers. There's pension funds are the big natural buyers and long end of the yield curve, of any yield curve. And if you understand what their behavior is going to be like, then you understand that, hey, listen, that's why Japanese rates are connected to German rates, are connected to Chinese rates, the U.S. rates, and sort of across the way. So if as you stated earlier, Japan long-term rates shot up 25 basis points in a day. That's going to have an impact on U.S. rates, no matter what, just because of the functioning of the market and the sort of the buyers in the system. And so, understanding that makes us realize that, Japan has to sort of get their stuff under control. And part of the reason why we didn't particularly freak out that bad on Tuesday was because we did see some of this technical price action happening, and it's not. We don't think it's a long-term sort of issue. If this was an inflationary issue or a growth issue or something else, probably a bigger deal. This is really kind of a specific idiosyncratic Japanese issue that sort of permeated throughout the rest of the bond market around the world. We think those effects will end up will dissipate because we do think Japan will do something about it eventually. But at the end of the day, we still got to sort of get through to the next day. And so it's just to understand what are the causes and reasons for some of the volatility we got. And it's definitely more on the rate side than it was on anything having to do with Greenland.
All right. Love it. Hard pivot, because we have got a markets take on a classic Hollywood gab show staple, Who Wore It Better? And as promised, today we're taking a page from the world of college sports. You might have heard the term NIL. It stands for name, image, and likeness. It's a system that lets college athletes get paid for endorsements, appearances, and brand deals, real money showing up earlier in their careers. So we're putting on two styles in this runway. On the left catwalk, the NIL Gold Rush. Our young millionaire athlete hits the catwalk in a shiny satin bomber, loud designer sneakers, and chains over the hoodie, all flash, all speed, all eyes on me. On the other catwalk, we got the old school scholarship look. This one is clean and classic. Letterman jacket, fresh chinos, and old leather cleats. Quiet confidence built for the full season. So Scott, do you want the quick payday with more noise and more risk, or the slower, steadier path that combines compounds over time, but means you better not get injured until the big pro signing. Is it the NIL gold rush or the old school scholarship that's wearing the current sports environment better?
Look, I mean, the current sports environment is definitely the flashy one. I don't think that's the more that's not the good longer one though. I mean, people are getting a little annoyed and a little bit upset with this. So like, I'll take the long, slow, boring one. Bring me back to the days of like not necessarily in my youth, but at least like 5 years ago.
Why in this environment where there's so much hype, so much momentum? Why go more slow, boring?
Because I think they are killing the goose that laid the golden egg in terms of college sports. I mean, look, I went to University of North Carolina in Chapel Hill. I'm a big basketball fan, big football fan, like all these teams. I don't have the foggiest idea who is on these teams from year to year. Like the entire roster turnover. Like I'm getting to the point where like I still care, but not nearly as much as I used to because we don't know the kids. And so like if you and so I will watch less. If you get a large decrease in viewing, like guess what that's going to do to the advertising dollars and the sort of the contract deals and everything else. Like you have to have people watching this stuff in order to get the advertising money, in order to get the NIL money for like the entire dominoes thing to not start getting knocked over. So I think if they make a couple of simple rules in college sports where they have kids, maybe you can transfer once and you have a 2-year deal or whatever it is. So at least the fans can get to know the kids a little bit again, at least know some of the names on the back of the jerseys as well as the front of the jerseys.
You have built your career on risk management, especially in the volatility space and the option space, derivatives. What message do you have for young investors, newer investors on how to manage your risk, how to get started and not blow up?
Understand what you're buying, like first and foremost. So one of the things that we're seeing right now that is frankly a little bit alarming to guys like me is
leverage.
Leverage that's hidden.
Okay.
So like if you know you're levered, if you know you're taking levered bets, then that's one thing. Then look, at least you're taking an educated guess, and maybe you're wrong and you blow up. Fine, that is what it is. You learn a lesson. But look, there are ETFs right now that have like so much leverage built into them that people don't even know that they're there. So my mom could be buying one of these things and because it looks good and it's got a 20% yield or something silly, and you don't get a 20% yield without a massive amount of leverage and risk embedded inside of that thing, and they're being hawked as stuff that's not really that way.
We've seen that movie before.
We have seen that movie before, and look, and it always ends the same way. So that'd be my caution to younger investors. Like, just please take the time and the effort to know what it is that you're buying. If it looks too good to be true, like guess what? It's not necessarily true, but you're taking more risk than you think you are. And at least understand the nature of that risk and like know your bets. But you gotta know your bets.
And we're hovering on record highs, and so you're getting into this market when things are pretty hot right now.
That part actually I don't mind too much, Brooke. I mean, like the most likely thing to happen after an all-time high is another all-time high.
That's true.
So I don't necessarily mind that aspect too. I just don't want people to be taking bets they don't know they're taking. That's it.
So let's just think about we haven't really had a bear market in about a little bit more than 3 years, and a lot of people are colored by their first bear market. So for a lot of investors, that's going to be the pandemic. One of the things we've seen is how quickly markets recover, and I wonder if you have any words on that.
Yeah, that's a fascinating topic. I could go talk a long time about that, but I'll shorten it up. It is like the fast recovering markets is definitely a something that's happened in the last 10 years, really. And we didn't used to see it like this. Mm-hmm. But that is a sort of a hallmark of markets in 2025, 2026, and beyond. And so I think the only thing I would say is like, yeah, you can probably count on it, but the first time that it doesn't happen is going to be nasty. So at least know that it's possible that markets don't always recover in a V-shaped fashion. Yeah. There's 100 years of history where that was by far the not the norm. User recoveries were much slower. So like, I guess if people are newer in the markets and they expect sort of this fast V-shaped recovery, just don't get totally freaked out if it doesn't happen immediately. Sometimes these things take a little bit of time.
And very wise words for people. I mean, in the market in general, people are looking increasingly for those quick paydays. Really appreciate you stopping by here. Learned a lot. Love Amara's Law, because that really explains, kind of gels with some of the other shows where we've been focusing on this is the year of enterprise AI. And on that note, we got to go. We have wound things down here in Stocks and Translation. We'll see you next time.